Okay, so what if I told you that delaying a single decision by just 10 years could literally cost you half of your total wealth? I know, it sounds like a massive exaggeration, right? But the math absolutely backs us up. And today, we're going to show you exactly why.
This is where we take all the intimidation out of building wealth and show you exactly how to put your money to work. Today, we're focusing on one seriously life-changing question. What is investing, and why should you start?
We're going to build up your financial literacy step by step today. We'll be covering saving versus investing, the magic of compounding, overcoming your mental barriers, core investment building blocks, the golden rule of diversification, and finally, taking your first steps. So let's jump right into Section 1, Saving versus Investing. Knowing the difference.
The absolutely crucial point here is understanding that parking your money in a bank account is very, very different from actually putting your money to work. Look, saving provides incredible security, right? It gives you quick access for short-term needs like an emergency fund. But investing, that's a completely different ballgame. It's a long-term strategy designed to acquire growth assets that build your wealth over decades. Now, yes, investing absolutely involves higher risk because there are no guaranteed returns, but the reward for taking on that risk is a much higher potential return.
And here is the real problem with just keeping all your money stuffed in a traditional savings account. While it feels super safe, it almost always loses the battle against inflation. Think about it. As the cost of living goes up, the cash just sitting in your bank actually loses its purchasing power over time. $1 today just isn't going to buy the same loaf of bread 10 years from now.
Moving on to Section 2, the magic of compounding. Time is your greatest asset.
To really see why time is your greatest asset, we need to look at the sheer scale of what waiting actually costs you. Let's say you invest $10,000 at age 25 with a 7% return. By the time you're 65, you'll have roughly $150,000. But if you wait until age 35 to start and invest that exact same amount, you'll only end up with $75,000 at 65. Waiting just 10 short years literally costs you half of your potential wealth. That is wild.
Let's look at another scenario from the data that really drives this home. Imagine person A. They invest $5,000 a year from age 20 to 30, and then they completely stop. That's just 10 years of investing. Now take person B. They start at age 30 and invest $5,000 a year all the way until age 50. That's 20 full years of investing. Yet simply because person A started earlier, that snowball effect of compounding means their total wealth at retirement will actually be significantly higher. Starting early is vastly more powerful than trying to play catch-up with larger amounts later in life.
Which brings us to Section 3, Overcoming your mental barriers. You belong here. Okay, before we dive into the technical stuff of what to actually buy, we really need to address the psychological friction that holds most beginners back. Do any of these thoughts sound familiar? I don't know enough. I don't earn enough to be an investor. I'm terrified of losing my money. You know, it is completely normal to feel choice overload or to have a fear of losing your hard-earned cash. But hear this, you do not need to be a wealthy Wall Street expert to start. You can start with incredibly small amounts, really just to build the habit.
Like Chief Investment Officer James Foote points out, there's no such thing as a sure thing. All investments are going to carry an element of risk, but starting with those small amounts really helps you build confidence. Experiencing those everyday market movements with just a modest amount of money turns that scary, abstract unknown into totally manageable, practical experience.
Let's get into Section 4, Core Investment Building Blocks, the assets you can buy.
So let's rapidly break down exactly what you are actually buying when you finally make that jump from saver to investor. First up, we've got stocks. When you buy a stock, you become a partial owner of that actual business. As the data highlights, stocks are a portfolio's heavy hitter. Historically, they've carried the greatest risk and the highest short-term volatility, but they also offer the greatest potential for long-term growth. You're basically taking on that bumpy short-term ride for the potential of strong returns over the long haul.
Next up, bonds. When you buy a bond, you are essentially playing the role of the bank. You are the lender to a government or a corporation. In exchange for your cash, they promise to pay you regular interest over a set time and then eventually return your initial money. Bonds act as a great stabilizing force. They're generally far less volatile than stocks, offering more modest but fixed income returns.
And finally, we have mutual funds and exchange-traded funds, usually just called ETFs. Instead of stressing out trying to pick the absolute perfect individual stock or bond, these funds pull your money together with a bunch of other investors to buy a massive variety of securities. This means you get to own a tiny slice of hundreds or even thousands of companies all at exactly the same time, which honestly brings us perfectly to our next rule.
Section 5, the golden rule, diversification, protecting your portfolio.
Now that we know the basic building blocks, how do we combine them safely to ensure we aren't taking on unnecessary risk? Well, think about this everyday scenario for a second. Why do street vendors sell seemingly unrelated products, like umbrellas and sunglasses? At first glance, it makes zero sense. Who is buying both of those at the same time? But this vendor is actually practicing brilliant risk management. By diversifying their product line, the vendor ensures they can make money, whether it's pouring rain or bright and sunny. Asset allocation works the exact same way. By spreading your money across different asset categories, like stocks, bonds, and cash, you ensure that if market conditions cause one asset to drop, another one might rise up to counteract that loss. It essentially just gives your entire portfolio a much smoother ride. And please, remember this golden rule. Time in the market beats timing the market. Successfully growing a diversified portfolio is all about consistent habits. Things like dollar-cost averaging, where you just invest a fixed amount at regular intervals. It is absolutely not about trying to magically predict the market's highs and lows. You just get in and just stay in.
And finally, Section 6, taking your first steps, your action plan.
So, how do you actually cross the starting line today? Here is your straightforward checklist. Step 1. Before you invest a single dollar in the market, establish a safety net. Get 3 to 6 months of cash saved up just for emergencies. Step 2. Start small and automate your investments so you build the habit without even having to think about it. Step 3. Choose your investment structure. And Step 4, if you're still feeling a bit nervous, practice risk-free. There are platforms like the ASX share market game that let you simulate real market conditions using virtual cash. It's a great way to learn. But actually, scratch that. Before you do any of that, you have to remember this fundamental rule highlighted by the SEC. Always pay off high-interest debt first. Honestly, very few investment strategies are going to pay off better or with less risk than simply eliminating your high-interest credit card debt before you ever dive into buying stocks and bonds.
So your money is ready to go to work for you. Are you ready to let it? You now have the exact roadmap you need to beat inflation, harness that sheer magic of compounding, and build a truly secure financial future. The only real question left is when you're going to take that first step. If 10 years of waiting literally costs you half your wealth, can you really afford to wait until tomorrow? Thank you so much for joining me on this explainer. Get out there, start small, and I'll catch you next time.